Hey folks, welcome back to the channel. Today, I've got a message that might save you from a really bad buy. I'm serious. Don't buy a home here until you finish this video, because I'm breaking down the 10 worst California cities to buy a home in 2025. These aren't random picks. They're based on hard data, boots-on-the-ground insight, and patterns I've watched unfold in real time. We're talking cities suffering from population decline, job shrinkage, crime spikes, decaying infrastructure, overbuilt housing, and collapsing investor confidence. California's got some of the most beautiful landscapes and strongest economies in the country. But not every zip code is a golden opportunity anymore. So grab your coffee, sit tight, hit that subscribe button if you haven't already, and let's dig in. Before we jump into the list, let's talk about what makes a city bad for buyers in 2025. When I'm assessing a place, I look at a few big red flags. Is the population shrinking or stagnant? Are people moving out faster than moving in? What's happening to jobs? Is there a real economy beyond service and retail? Then there's the issue of crime. Violent and property crime drive insurance costs up and buyer interest down. Add in infrastructure, crumbling roads, weak city budgets, poor schools, and you've got a recipe for long-term value decline. And don't even get me started on overbuilt housing markets that can't sustain the demand they were banking on pre-pandemic. If a city hits multiple of those warning signs, I stay away, period. Let's start with number 10, Bakersfield. Bakersfield often shows up as the affordable part of California. And sure, home prices look tempting compared to coastal cities, but affordability doesn't mean value. Bakersfield's job market is limited, heavily tied to agriculture and oil, which both face volatility. Air quality is terrible, water scarcity is constant, and infrastructure is overstressed. While it's not the worst in crime, it's not great either. Add it all up, and you're looking at low growth potential, minimal appreciation, and maintenance headaches. Cheap homes here can trap you in a cycle of repairs, tenant turnover, and weak resale demand. Number 9, Stockton. Stockton's story is as old as modern California decline. It went bankrupt once already. And while it's made a comeback, the fundamentals are shaky. High crime rates, pockets of blight, economic inequality, and a city government that's constantly patching holes instead of planning long-term. You can find houses for a fraction of what you'd pay in Sacramento or San Jose. But there's a reason they're that cheap. Investors move in thinking they'll flip or rent. Then they face vandalism, theft, long vacancies, and tough tenants. It's not that no one ever makes money here, but it's not worth the stress or risk unless you know the city block by block. Coming in at number 8, Modesto. I get asked about Modesto all the time because it's close to the Bay, and folks think, hey, it's a commuter city, that's gotta be good. But that logic fell apart post-pandemic. Remote work slowed migration, and now Modesto's left with stretched infrastructure, a fragile job base, and rising crime. It doesn't have the lifestyle pull or strong employment engine that makes other inland cities resilient. And the appreciation you'd expect just hasn't materialized. You can buy cheap, sure, but there's no real growth driver anymore. Now, number 7, San Bernardino. I've seen investors call this the next inland empire opportunity, but the numbers don't lie. The city's been struggling for decades. Crime is high, city services are limited, and infrastructure investment is lagging far behind. Add to that rising insurance costs and maintenance nightmares, and suddenly your so-called deal turns into a slow financial leak. Unless you have deep local knowledge or a redevelopment angle, San Bernardino's a trap for the unprepared. Number 6, Oakland. I know some of you just gasped, but listen. I love Oakland's spirit. It's vibrant, diverse, full of potential. But that potential has been weighed down by persistent crime, business closures, homelessness, and a struggling public safety system. Even investors with long-term plays are seeing softening rents and slowing appreciation. The proximity to San Francisco used to be Oakland's golden ticket. Now it's more like an anchor, because SF's downturn drags it down too. There are still good neighborhoods, but the margin for error is razor thin. If you miss the mark, your property can lose value fast. Sliding into number 5, Emeryville. Tiny city, huge problems. On paper, Emeryville looks hip, modern, and walkable. It's full of lofts, mixed-use buildings, and cool coffee shops. But behind that facade is one of the highest property crime rates in California. I've seen multiple clients invest here thinking they were buying into an up-and-coming tech corridor, only to watch insurance premiums skyrocket and tenants move out because of safety concerns. And since the city's so small, one bad trend, like a business leaving or a crime wave, hits the local economy hard. Number 4, Vallejo. Vallejo's an interesting one because people think it's undervalued since it's near the bay. But there's a reason it's undervalued. Vallejo has battled municipal financial instability for years, with repeated budget issues, slow city response times, and crime that fluctuates but never really disappears. It's one of those cities where you can feel the strain: neglected infrastructure, uneven neighborhoods, and inconsistent enforcement. I've walked properties there myself, and while you can find opportunity, it's more gamble than strategy in 2025. Number 3, Richmond. Richmond is another tough market. It's got some beautiful views and promising developments, but the city has a long-standing reputation for crime, pollution from industrial zones, and general economic instability. You can literally have one block looking nice, and 2 blocks over, it's a completely different story. If you're not deeply familiar with the local terrain, you're likely to misprice risk. And in today's lending environment, even small surprises can wipe out your profit margin. Now, here's a surprise for some. Number 2, San Francisco. Yes, you heard me right. The city by the bay, one of the most iconic real estate markets in the world, is now one of the riskiest for 2025. Prices are astronomical, yields are microscopic, and the city's facing an identity crisis. Remote work hollowed out downtown, office vacancies are massive, and the homelessness and crime issues are pushing people out. The tech exodus hit harder than people realize. Add in regulatory hurdles, sky-high taxes, and maintenance costs, and suddenly even million-dollar condos are sitting unsold. Unless you're playing the ultra-long game with deep pockets, buying in San Francisco today is like catching a falling knife. And that brings me to number 1, Signal Hill and similar small distressed cities like Commerce or Marysville. These places don't get national headlines, but they're quietly some of the worst investment traps in California. Tiny tax bases, weak infrastructure, high crime relative to population, and almost zero growth drivers. The problem with small, struggling cities is that one economic shock, like a factory closing or budget cut, can devastate the whole local market. There's no buffer, no rebound mechanism. Investors often think they're buying low, but they're really buying into stagnation. So, what do all these cities have in common? They're dealing with a toxic combination of outmigration, economic fragility, and high operating costs. They don't have sustainable inflow of talent or capital. Their tax bases are shrinking while expenses rise. And in 2025, when interest rates are higher, lending is tighter, and buyers are cautious, these cities get hit the hardest. The dream of cheap California real estate just doesn't work when your insurance doubles, your tenants vanish, and your property depreciates. Now, if you still feel tempted by low prices, I get it. We're investors, we see opportunity everywhere. But if you must invest in one of these risky zones, do it with eyes wide open. Analyze block by block. Verify crime data yourself. Stress test your numbers, assuming rent drops and repairs spike. And have a rock-solid exit plan. Don't buy anything you can't hold for at least 5 to 10 years. Keep heavy cash reserves. And if possible, look into land or specialized use properties rather than traditional housing stock. Sometimes the dirt's safer than the house sitting on it. At the end of the day, California still has incredible opportunities in select markets with population growth, diversified economies, and smart governance. But these 10 cities are the opposite. They're where optimism meets denial. As investors, our number one job isn't chasing hype, it's avoiding traps. So if you take one thing from this video, it's this: be cautious, be selective, and don't assume a low price equals a good deal. Thanks for watching. If you found this useful, smash that like button, drop a comment below, and tell me which city you think is overhyped or underrated right now. I'll be dropping a follow-up soon about the best California cities to buy in 2025, where the fundamentals actually make sense. Until next time, stay sharp, stay local, and as always, invest smart.